based on market segmentation theory.
Yeah.
Sir, I could not find any explanation. So could you specify anything?
So
Or is it yet to be discussed?
market segmentation.
No, sir. The part where you said that the explanation of Sri Lanka and Turkey will come from.
So actually, what you must have seen, various type of yield curve. Most of the time, this kind of upward slope curve, or in certain case, you may find downward slope, and in certain case you may find some kind of flat curve. So it depends on the various macro situation. Basically, why macro situation I'm talking about? Because your short-term rate. So like the relationship between short-term rate and your long-term rate. So this curve is going to be decided. For here, you can see this kind of relationship, like short-term rates are going to be higher than long-term rate. And when we consider market segmentation rate, theory, this theory suggests that you have various segment. Let's say 5-year bond segment. There you will have different demand and supply schedule. And same way you will have different type of demand and supply schedule when we consider 10-year maturity bond or bond with different maturity. So basically, based on these, you will have different kind of rates. So here you can have different rate. Same way here you will have different rate based on demand. And if you remember our discussion on demand and supply, how demand and supply for fund decides equilibrium rate or interest rate. So same, with that assumption, you may have 5-year here, 10-year here, and then 20-year here. And because all these are rates are based on demand and supply in that section itself, or in that category itself, your rates are varying. There is nothing to do with a 5-year bond with 10-year bond. And whereas if you look at previous theory, like either unbiased equilibrium theory, this theory, or when we talk about liquidity premium theory, it connects all that investors are going to consider all the maturity, all the bonds or all the securities available across different maturity. And that's why the rationale, when we talk about this, we said investors are rational and they will decide based on availability of various bonds or various instruments at a given point of time. So in that way, your these the theory is going to differentiate with each other. So in your case, why I said market segment theory is very much related, or you can basically across examples, whether you have picked US versus China, US versus Turkey. In all these cases, you can easily fit market segmentation theory. And that's why many economists, they do believe that market segment theory is theory that properly connect with the with the time to maturity and yield across the various instruments, basically yield curve. So that's what that's how we can relate yield curve with the market segmentation theory. Yeah. Any other question? Yeah, Anuj, is whether this explanation provides you some kind of satisfactory response to your question?
Yes, sir. I'll look into that direction and
Yes. So
try to
you
get that.
think about when you see your your submitted assignment, or when you look at any yield curve, you try to see that if you have different set of investor, and they are looking different maturity instrument, how demand and supply, basically how demand and supply within that category is going to decide return or yield. And that yield, when you plot with across various maturity, that curve will show you a yield curve, right? So I think, yeah, this is what we have covered till yesterday. So I'll start our discussion from this slide onwards. So we have already discussed this, if you remember, in each category, how based on short-term and long-term rates, your yield curve is going to be decided. And this could be, along, several points based on various maturity, and based on these, different rates, your curve is going to be decided whether upward, kinked, or downward slope. So it is going to be decided based on yield across various maturity. Now, so this is what, all these three theory related to term structure of interest rate we have covered. And you can further, there are, within these theories, sometimes you will find overlap of, unbiased expectation theory and market segmentation theory. So the way you argue about particular curve and how you relate that, you can do it using all these three theories. And this is another indicator. We call it financial stress indicator. So what this captured already, one indicator we already looked at is yield curve. If you remember, yield curve means we are talking about basically term structure, yield versus your time to maturity. We know how variation in yield curve will tell you what would be the expected future of economy. Same way, we have another indicator, we call it stress indicator, because this data I have taken from St. Louis. So if you just type Federal St. Louis database, so that database provides you various details, various data set. And here I have looked at for this data, this time series. So here you have three recession period. This is dot-com burst, if you remember, 2001, 2002. This is 2007-8 global crisis, and this is recent COVID situation. So here, if you see, this is a federal or financial stress indicator, is basically yield between 10-year government bond versus yield of 3 months. So basically this is long term minus short term yield or expected interest, short term. So this difference we are calling financial stress indicator. So can anybody tell, now we know there are instruments which capture short term return or interest rate, and we have instrument that captures 10-year yield. So when we are taking difference, what exactly we are going to capture? Can anybody tell? Already you have this graph available.
So the spread.
Yes, yeah, spread, yeah. And beyond spread, how you will interpret? Spread, your one-term explanation is correct, but beyond spread, how would you, for if you want to explain to normal person who want to make sense of this particular graph, how would you explain? Others? Amardeep, are you there?
Yes, sir.
Yeah. Can you at least try to relate this graph and definition of financial stress index?
Sir, the financial stress index can be negative or positive. Like this 3 month interest rate may be higher than the long term or the short term.
Hmm. So let's say I am giving you example. Let's say for given time, let's say at t is equal to, at this time, this gap between these two is, let's say, 2%, and another time period, let's say t is equal to 4, or 4 could be any year you can thought of, let's say 5%, and another scenario you have t is equal to 9. This FSI is, let's say, around 20 basis point, is, let's say, 20 basis point. So what would be your explanation if you see this? What would be your explanation? At least these three time period respective to each other.
So, sir, as the difference between long-term investment and short-term is increasing, so the economic growth is increasing, like for a country or so.
But why are you assuming that economic growth only depends on 10-year, or economic growth only captured by 10-year government bond? Is it so? Economic growth could be short term as well.
So, sir, in a long term, we can see for like 10 years,
Hmm.
the economy will grow.
Okay. Any other interpretation, other students? Even graph is there. You should be able to relate. Anyone? So this is based on weekly data set. Yash, Jadhav, Yash, are you there? Karthik,
Yes, sir.
yeah.
Sir, if we say the FSI is positive, then, or if it is a higher positive value, then we say it is the yield curve is a normal type of curve. And for T9, if it is 20 basis point, it is a very low percentage. So we can say it is a flat type of curve.
Hmm. Let's
And,
say, yeah,
and
I want explanation based on some kind of what we call sentiment. Whether this type of variation, whether it gives you any kind of hint about economy or not. That kind of explanation I'm looking for.
sir, we have discussed that during a recession period, the yield on a shorter security is going to be high than a longer security.
Hmm.
So during a recession, we expect a negative
So
kind of
if
thing.
that is the case here, if you see, this is around how much? Around 9%. 9% means if your long-term rate is around 12%, and assuming that short-term is 3%, then only you are going to get this.
Yes, sir. So I'm confused by seeing this.
Hmm.
Uh,
See, what this basically 10-year bond yield is a kind of proxy about the future, right? So what this graph is telling, you have two time horizon. One is here, if we plot, so let's say this is my 10-year time horizon and this is my 3 months. So this indicator talks about how people perceive investing in 10-year versus investing in short term. And whenever you find that the stress, or when you find that market is not doing well, so rather than investing in short term, because in short term that COVID, like for example, if we take COVID situation, we still know that in coming few months or coming 1 or 2 quarter, COVID situation is not going to be normal as it was in 2019. It means the expectation of individual or expectation or sentiment about short-term investment won't be very much promising for the investor in 3 month treasury bond or 3 month investment option. And that's why, whereas people are still assuming that if they invest in 10-year bond, at least that bond will give some kind of support or some kind of financial stability in long run, because in long run government is going to surpass or going to tackle this kind of COVID situation. So if you consider that kind of scenario, or already you have that kind of scenario, the gap, your long term is not going to be much affected, but your short term yield on treasury bond 3 month, 9 month, that are going to be affected, because these are very close to your time period. You can at least up to large extent you can guess that this is what going to happen in coming few months. And that's why whenever the spread between 10-year long-term expectation versus short-term, because these two are a kind of proxy for short duration, how things will go, and long duration, how things will go. If gap between these two is very large, it means a kind of stress in economy. It means economy is not in a normal condition, and that's why people believe that short-term investment and long-term investment both are very different, and that's why yield on these two type of instrument having lots of variation. Otherwise, if you consider here normal period, so this is if I'm not wrong, this will be around how much? This will be around 1.5%. And here also this will be around 1.5%. So in US, because inflation is not as much as we have in India, so because of inflation, the interest rate offered or yield on long term and short term is not very much. Even in India, if you go, it is around 6.24%. In initial side, once we cover this, I'll go to our initial slide. So there, when we take the difference between 10-year India versus US, because of inflation rate, that difference is large. But in US, inflation rate is around 3% or so, within 3%. It is almost stable from last 5-6 years. So because of that, you will find that your band, basically this band is around 3% plus minus 1.5%. And whenever that band is crossed, means when people having very different expectation about long term versus short term, yield on long term versus short term government bond, that tells you that this is a point of economic stress. And that's why this indicator, we call it financial stress indicator. It means people are very much they are considering that very different situation altogether in short run and long run. Long run means I'm talking about 10 years. So this could be whenever you are analyzing a particular economy, you may want to look at this kind of measure, financial stress indicator, and that is going to help you a lot. Let's say if you are not able to make any proper judgment by looking at the yield curve, then when you take the difference between short-term expectation, short-term yield 3 month versus 10-year government bond, then that will index or that series will help you to see how people see short-term versus long-term investment. Right, so this is what this is very good indicator in future whenever you are going to do some analysis. This can help you a lot. Now I'll go to our initial slide. Just few seconds I'll spend. See here in India. So this is 10-year bond, and right now it is somewhere 6.24%. That day when I took this, it was 6.24%. And when we look at US, in US same day it is around 1.127%. And if I'm not wrong, in US inflation rate is around between 2 and 3%. So real in yield or real interest on this 10-year bond is basically negative. And in case of India, I think inflation rate is around 5 or so, between 5 and 6. So here also, if when you calculate real interest rate, you may have small positive or maybe negative. So that's what I was telling, that when we look at the in yield offer in India versus US, because it should also take care of your inflation part, and that's why a difference you will find when we consider India versus US yield curves. So now we will move further and see what other terms are there. Already we have discussed these terms, but in finance theory or in financial economics theory, we have these terms. So if you remember three terms you are aware of. One term is expected return or interest rate. So yield you can talk about, yield or interest rate in unbiased expectation theory we talked about. If you remember, V represented by E 1 R1, something like that, 2 R1. 2 means in which year you are standing, and this is 1 year ahead. So basically between 2 and 3 years, what would be the expected return or yield? And we also talk about spot rate. Spot rate in spot market. So we represented that rate by this in liquidity premium theory and in your unbiased expectation theory. Now, with this understanding, now we will see what are other terms that are very frequently used whenever we talk about interest rate or we talk about yield or term structure. So another term is, we call it forward rate. So basically what forward rate is the expected or implied rate on short-term security that is to be originated at some point of time. Basically, forward rate is nothing but your this rate, expected rate. Why expected rate? Because here for every year. So this is, so if I put like this, 1 year, 2, 3. So in expectation theory, what we said, the ERP, E2R1 is the expected interest or yield that you will earn in this time period for 1 year, because here you are buying instrument here up to year 2. So this is what expected return would be. Same way for this E3R1. So here you are only buying for short duration. So if short duration is 1 year, then we can also call that expected return or expected rate as forward rate. So So basically both terms are synonymous. We can replace one with each other, but based on the context, we will be using. Now, this is the equation. If you remember, when we talk about 2-year rate, so there we had this term E2R1. So basically both are synonym, whether we call it forward rate or we call it expected rate, we can we can replace each other. So how we can find implied forward rate on 1-year security to be issued 1 year from today. So what we are saying that you have this kind of setup, 2-year time horizon, and in this time period your spot rate is this, and here I want to know what would be the forward rate or implied forward rate. So how you are going to do, if you remember this relationship 1 plus, so you will be indifferent between buying a security for entire 2 period and expect your return will be this, or yield on that instrument will be this, with respect to buying instrument, two instrument, one offering you spot rate this, and another will have implied forward rate this. So from this, if we make certain changes, then this rate we can calculate. And how we are calculating, because this is basically 1 year is bond issued today, and this is 2-year bond issued for 2 year today. So using these two, we can basically calculate forward rate. And one of the student, he has also asked question. Remember, he said how we are going to calculate expected return. Expected return, because E2 R1 or E3 R1. So that time I said, for time being, we assume that these rates are known, but actually if it is not given, then by calculating the forward rate, we can calculate the expected return. But you need input, either you need yield, or yield on 1 year bond issued today versus 2-year bond issued today. Otherwise you won't be able to calculate. So this is other way around. And I'll go back so that you will be able to relate. If you remember, we already discussed this. So this is nothing but your implied forward rate, F2R1. Same way, this will be F3R1. So here it was, in this case, what we said, forward rate or expected rates were given. But in our, and then from there, what we calculated different maturity instrument, because here this is 1 year, 2 year, 3 year, 4 year. So basically these are the instrument issued today, having 1 year maturity, 2 year maturity, 3 year maturity. And when we plotted, we got this kind of yield curve. And here what we are calculating basically the forward rate for between time periods here. So that is the difference we have. So you should be able to easily relate that forward rate is nothing but your expected return or expected interest rate that we discussed in previous theories. Here we have one question. For example, let's say on May 6, 11, the existing spot rate on 1 year, 2 year, 3 year, and 4 year coupon treasury bonds are these. So this is 1 year, 2 year. So remember, so if I want to draw yield curve, I can easily draw, let's say here up to 2%. This is your 1%. So this is your yield. So basically these are your yield on different maturity. So 1, 2 year, 3 year and 4 year. For 1 year it is somewhere here. For 2 year it is somewhere here. For 3 year it is, and for 4 year somewhere here. So if I draw this, so this is nothing but your time to maturity. So this is your yield curve, or we can call term to your term structure. Why? And it we are getting because we have already different maturity instrument details. Now here, how we can calculate forward rate using this formula? If we generalize this for n time period, so we can generalize this easily for n time period, and with that we will be able to calculate all these terms. So for second year, so one year we will take, and then I'll assume that second year. So here you have 1, 2. So in this time period you have, let's say 2F1. In this time period 1 plus 3F1. So I'm assuming this is how we are representing. So here what we know that 1 plus 1 R2 square is equal to 1 plus 1 R1. This is nothing but your spot rate, and this second term here for second year 1 plus 2F1. And when we solve then and replace all these values, we can calculate this part. Same way for third year. We can do. For fourth year we can do. So in this way we will be able to do. For third year, remember for third year how we can do. For third year we have this. So I can do this 1 plus 1 R3 means, because this is my 1, 2 and 3. So here the interest rate that you will be getting is this for 3 years, which is given to you. 1 plus you have 3F1, and already we have this 2 year. So with this, using this formula here, we will be able to calculate, and that we will be doing. This part is clear how we can calculate forward rate.
Yes.
Okay. Now,
Sir,
yeah, where we are, yes.
why was there a square in the denominator? Square or cube?
Because it is going to be, see, when we are, this is geometric series, and I'll show you from where it is coming. This, can you remember?
Yes, sir.
So here, because this is for n time period, means if time scale, if I plot, this is coming from geometric series, and 1 plus 1 Rn. So this time period is n. That's why we are using that the what we call, this is n time period geometric series, and that's why we are putting n. This is basically compounding. If you, I'll be discussing about compounding in coming today itself. So this is basically end time period compounding we are talking about. Why it is compounding? Because when your interest rate, whatever interest rate is known, this interest rate is basically nominal interest rate, and to adjust for various time period, we need to go for compounding. And here when we consider two time period, let's say when we consider two time period, let's go back to that here. So if I rewrite this, how I'm writing, let's say I'm taking one another side, this power 1, right? Can you see power 1 into 1 plus 0. 0.00205. Basically, this is nothing but your 1 plus R1, and then 1 plus your sorry. So this is basically 1. This is 1 plus this one, 1 plus R2. This part is 1 plus 1 R1. So this is spot rate. So in this time scale, if we draw.
So for a 3 period time for 3F1, the spot rate for 2-year time period would be used, no sir?
Yes.
And why is it squared again? Because we are already
because of compounding principle. This is basically every interest rate is is going to be compounded over the period.
This interest rate is an annual
nominally, yes. So that's why number of time period, your square term or to the power whatever term you are using, it is going to be compounded.
Yes sir.
And so let's say one here, what we are doing, we are writing this. So in this time period, 1 plus 1 R2 square. Square means here when we are calculating, because this is second time period, so it is going to be compounded for this and this, and that's why square term we are using when we are putting here. And same way when we are using this third year. In third year, remember, you have 3 terms. This is nothing but your third year term, basically 1 plus 1 R3, 1 R2. So here this is going to be compounded for 1, 2, and 3, and this is going to be compounded for 2 years. And with that we are getting these expression.
Yes sir.
So remember, number of time it is going to be compounded. That many times we will put your power or square cube, whatever is there, based on time period. Now, so you were asking why we are doing so. We are in when we going to discuss about time value of money, there we have concept of compounding and discounting. So your question regarding why we are compounding, you will get answered here in this topic. And how many of you have already know about time value of money in and out? Can you please raise your hand? So here in this case, I'm going to talk about time value of money. Only one. Okay, Vaibhav. 2. Just raise for a few seconds so that collectively I'll be able to see. Only 2, 3. So 4, So what will I'll do here? My entire discussion would be based on interest rate. You may have used time value of money related to investment, but my focus, of course, I'll be using certain, what we call cash flow or some kind of payoff when I'm going to use time value of money, but my entire focus would be on interest rate. How interest rate is basically a key factor in time value of money, basically compounding and discounting, because interest rate, from where it is coming, now where it is going to be used, because unless you know application, because a bond is one of the instrument that we use in financial market. Equity we use in financial market for raising capital. How we are going to value, because valuation is also part in our course. So when we are going to evaluate or value those instruments, we need to know why we are discounting and why we are using interest rate. So now so far we know from where it is coming. So with that understanding, we are going to do quick revision, or a quick use of time value of money to evaluate the value of certain instrument. So these will be the application of interest rate. As I said, in time value of money, it is used, and this is the fundamental of finance and economics. Remember, if you have well understood time value of money, I'm sure 70 to 80% concept you can easily understand by yourself. You don't need any any kind of resource. Only what you need to know, how your cash flow will be different, or payoff will be different. So I'll go through quickly. First, we will try to understand simple interest rate and compound interest rate. So simple interest rate means interest rate that we earn on only principal amount. So for example, here we have 2-year case. When we calculate simple interest rate, here you have $1,000 as principal, and 12% is your annual interest rate or nominal interest rate. So your simple interest rate would interest would be 1,000 into 1.12. So basically your so total your amount would be after 1 year 1,120 rupee. Means you got basically 120 as simple interest for 1 year. Now in second year also, your interest rate is going to be same. When we talk about simple interest rate, your principal amount that you had initially, this much. Second year your interest rate would be 12% on 1,000 rupee, and second year also you will have same. So basically here you are going to get 120, here you are going to get 120 rupee as interest component, and when we add, so you will have 1,200. So this is what simple interest rate is. Very simple, because there is no compounding. But how it happens in banks and other cases. In case of compound interest rate, what will happen? Let's say here you have 2 time period, 1 and 2, and here you deposited 1,000, and in applicable interest rate for each year is 12%. So what will happen? Here you had 1,000, and after a year you will get 1,000 plus 12% interest on 1,000. So 1,000 into 0.12. So here your amount will be this much. And next year, basically now you are investing this. Earlier in simple interest, it was assumed that your principal amount is the same. There is no change. But in compound case, what will happen now? Your next year amount is this much. And on this, you are going to earn 12% interest rate. So here, this plus 12% on your amount. So what is happening? Your not only your principal is enjoying 12% interest rate in compounding case, but also your interest component, 120 interest component, is also going to earn 12% interest rate. So the difference between these two, here you had this much amount, whereas in case of your compounding interest rate, so ultimately you will have 14 rupee, $14.40 as additional payoff or income when we calculate in terms of compounding interest rate. Compounding, why we are calling? Because your interest and principal both are going to be compounded. And generally two type of in bond or in various instrument, two type of cash flow you will find. One we call it a lump sum amount, means you invest $1 today and after some time period you will get some amount. This is one case. And there could be a case where you invest regularly a series of equal investment. It means in first case, this is n time period and this is t is equal to 0. Here you are investing some money and you are expecting to get here, your initial dollar plus some big delta dollar in future. So this is basically your lump sum payment. Why lump sum payment? Because you have only single cash flow initially, and then after some time period, this is kind of fixed deposit, let's say 5 year, and could be 5, 10, 15, 20, whatever we assume. And when we talk about annuity, annuity means a kind of payment which is regularly happening. So here at t is equal to 0, so you invest some amount regularly, like save in some kind of recurring account, you are saving something up to n time period. So it means all these amount will get some kind of compounding over this time period. So your calculation is going to different. In this case, your final, if initially you are investing let's say a amount, it is going to be compounded at R rate for n. So this is going to be your future value of lump sum amount. Lump sum amount is this, and future value of lump sum amount will be this. Why? Because the R is interest rate annual. It is going to be compounded for every year, assuming that your time period, one time period is equal to 1 year. So that's why even in our previous discussion, when somebody asked why we are using 2 or 3, I said that this is because of compounding. Number of time period your investment is going to be there in the system, or it is going to be used as an investment. That many n or power we will be using, or we use. So that's why this compounding concept was used. And more or less, I believe this is very easy, so you can easily do that. So this is in case of future value. Future value, as we have seen for lump sum amount, is a into 1 plus r to the power n. R is nothing but your interest rate that you are going to earn. So it means as interest rate will increase, your value of your investment, your future value that you are going to get, it will keep on increasing. So this is what we are calling as future value. It means you invest today and what you are going to get in future, but it could be other way around as well. For example, if you want to know what if you are getting, let's say, 10,000 US dollar in future after, let's say, 6 years, and you want to know what is the value of 10,000 today at prevailing at certain interest rate. For example, one investment option is there where it will give you 10,000 US dollar after 6 months, saying that if you invest 5,000 today, that kind of case we consider. And assume, if we assume that current market interest rate is R, so here this is for 6 years. So whether you should consider this investment or not. So this is more practical case. So what exactly you need to do? You need to calculate what would be the present value of this 10,000 that you will be getting at the end of 6 years. It means if I simplify this, let's say I'm writing this as A, and this is some amount. So following our so basically A is what? A into 1 plus R, similar to your future value if you remember, R to the power n, and here is 6 is equal to 10,000. It means if I further solve this, A your will be 10,000 divided by 1 plus R to the power n. So when we calculate the present, it means the present value of this today we can calculate using this example. So basically present value of certain amount. So this is your amount, 1 plus interest rate to the power 6 or n. So if we want to calculate the present value, the relationship will be opposite. So as interest rate will increase, because present value is nothing but amount that you are going to get in future, 1 plus R to the power n. So as interest rate will keep on increasing, your present value will keep on decreasing. And also it also depend upon your number of years, for how many years you are going to calculate present value. And when we are dealing with annuity is, let's say you are what you are doing, you are you want to calculate the present value of annuity. Let's say you are depositing 10,000 every year as saving account for 6 years, and you want to calculate what is the value of these investment that you will be making over 6 years today. It means this value should be discounted here, this value should be discounted here, same way this value discounted here. So and if I add all values together, so basically your present value of all these 10k will be 10k divided by 1 plus R, plus this is second year, 1 plus R square, 10k divided by 1 plus R to the power 6. So basically this is a GP series, if you remember, geometric progression series. And if we go for generalization, so this is how we can calculate. So your present value would be amount, that annuity, this is basically your annuity. Annuity means a regular amount which is received or paid. We call it annuity at the end of every time period. So here you see at the end of first year, 10,000 is deposited. Here 10,000 at the end of second year, and because it is end of time period, and that's why we are calling annuity. When this amount is deposited at the beginning of the period, so here when we call annuity, annuity means end of period, means amount, regular fixed amount which is paid or received at end of period. And when we have another term, we call it annuity due. Annuity due when this payment is at the beginning of time period. Beginning of period means at the beginning of year you are receiving or paying 10,000. So we will be calling annuity due rather than annuity. This formula we can use for calculating the present value. So next session, what we will do, we will do more a few exercises on this, and then we will go with this understanding. We will go and discuss about how we can value, or what is the approach we can use to value bond and share, which is basically valuation of equity and debt instrument. We will be doing in the coming week. So if you have any question, I'll take it. Otherwise, we will close our today's session. Yeah. Any question? So today, what we have done, we have gone through that three theories related to term structure. Then we talked about forward rate. What is the forward rate? How we can calculate it? How it is related with the your expected yield or expected rate that we discussed in unbiased expectation theory and liquidity premium theory. And then we started our discussion related to our application of interest rate. And then we talk about what is the present value and future value, and how we can, what is the present value of lump sum amount, future value of lump sum amount. And then we just started annuity part, where annuity is a fixed amount which is paid or received at the end of time period, whereas annuity due is the amount which is paid or received at the beginning of each time period. So that is the difference between annuity and annuity due. So any question? If you have any question, I'll take. Otherwise, we will close today's session. No question? Okay, so thank you. So we will meet next week, and if you have any question, you can put it on MS Team. We can discuss it, or we can discuss in next week, our first session on Wednesday. Fine. So thank you.
Thank you, sir.
Thank you.